So, hello, my colleagues, and I hope everyone is well. The purpose of this video is to discuss with you the difference, and I'm in both of these, and these are important to know about the difference between exchange traded funds, otherwise known as ETFs, versus mutual funds, and the tax advantages of exchange traded funds. So, we should move on this a little bit. And I want to discuss these tax advantages. And if you look here, it says, in a nutshell, ETFs have fewer, and they use the term taxable events. Okay, so I just want to make that clear. Taxable events than mutual funds, which can make them more tax efficient. So I want to go through that. And this way we can learn a little bit about that, right? You want to know about that. So ETFs can be more tax efficient compared to traditional mutual funds. Generally, holding an ETF in a taxable account will generate less, and this is very important, less tax liabilities than if you held a similarly structured mutual fund in the same account. Okay? Now, I got a little problem, and let me explain to you my problem. Actually, let me see. I own both. And here's the problem. If I wanted to take my mutual fund and put it in a ETF, most likely I'd have to cash out and I would have a huge tax liability, and then I'd have to move that money into an ETF. So actually, I'm in the process now of trying to get that all squared away, okay? Because I don't like paying taxes. Because I've been in a mutual fund for years, long before ETFs came out. From the perspective of the IRS, the Internal Revenue Service, our enemy, the tax treatment of ETFs and mutual funds are the same. Now that's interesting, right? Both are subject to capital gains tax, right? And everyone should know what a capital gains tax is. If you buy something, right, and then you sell it at a higher price, that difference in price is called a capital gain, and you're going to pay tax on that capital gain. Okay? So let's say I bought a stock at $10 a share, and then it went up to $50 a share. I would pay tax on that difference of $40 a share, right? That's called a capital gain. However, ETFs are structured in such a manner that taxes are minimized for the holder of the ETF, and the ultimate tax bill after the ETF is sold and capital gains taxes incurred is less than what the investor would have paid with a similarly structured mutual fund. Okay, and we should find out why on that. So let's scroll down a little bit here. I don't think I'm allowed to scroll unless I get out of the I've got to get out of the drawing package here. Let me pause for. All right. So we're up to here. Taxable events in ETFs. In essence, there are, in the parlance of tax professionals, fewer taxable events, right, in a conventional ETF structure than in a mutual fund. And here's why. All right, so a mutual fund manager must constantly rebalance the fund by selling securities to accommodate shareholder redemptions or to reallocate assets. Okay, so that's one thing. So we got to highlight that a little bit, right? Now let's see if I could. So this. So the sale of securities within the mutual fund portfolio creates capital gains for the shareholders, even for shareholders who may have an unrealized loss on the overall mutual fund investment. So as selling is going on, you're going to be getting capital gains, right? So it's important to know. So we got this, we're going to be capture these capital gains, all right? All right, now here's the important point. Here's the important point. In contrast, an ETF manager accommodates investment inflows and outflows by creating or redeeming creation units. And this is an important word. And this is what goes on in an ETF, which are baskets of assets that approximate the entirety of the ETF investment exposure. Okay? As a result, the investor usually is not exposed to capital gains on any individual security in which in the underlying structure. So this is a most important difference. You're not exposed to any individual, and let me underline that. So you notice the word individual securities here, right? Individual security, that's important. To be fair to mutual funds, managers take advantage of carrying capital losses from prior years, tax loss harvesting, and other tax migration strategies to diminish the import of annual capital gains taxes. In addition, index mutual funds are far more tax efficient than actively managed funds because of lower turnover. Okay? So I'm going to pause. For the most part, ETF managers are able to manage the secondary market transactions in a manner that minimizes the chances of an in-fund capital gains event. It's rare for an index-based ETF to pay out a capital gain. When it does incur it, it's usually due to some special unforeseen circumstance. So this is important here. This is real important. So I highlighted this portion here. So moving on, of course, investors who realize a capital gain after selling an ETF are subject to the capital gains tax. And of course, we all are. Currently, the tax rates on long-term capital gains are 0, 15, and 20%. These percentages are based upon your taxable income, and depending on your modified adjusted gross income, which is the infamous AGI. So let's, right? You might have to pay an additional 3.8%. The important point is that the investor incurs the tax after the ETF is sold. Okay? Now that's the important point. After it's sold, not during while you're holding it. All right, so ETF dividends are taxed according to how long the investor has owned the ETF fund. All right, so let's highlight that because that's an important consideration, right? If the investor has held the fund for more than, I can't see that, I believe 60 days before the dividend was issued, the dividend is considered a qualified dividend. Okay? So that's more than 60 days. And is taxed anywhere from 0 to 20%, depending on the investor's income tax rate. If the dividend was held less than 60 days before the dividend was issued, then the dividend income is taxed at the investor's ordinary income tax rate. This is similar to how mutual fund dividends are treated. All right, so there's a lot of similarities with regards to how long you're holding the dividend you get. Okay, so that's an important point. All right, so let me scroll down a little bit. Exceptions to the rules. Certain international ETFs, particularly emerging market ETFs, have the potential to be less tax efficient than domestic and developed market ETFs. Unlike most other ETFs, many emerging markets are restricted from performing in-kind deliveries of securities. Therefore, an emerging market ETF may have to sell securities to raise cash for redemptions instead of delivering stock. This sale would cause a taxable event and subject investors to capital gains. All right, so anyway, so it goes on here, and they talk about now leveraged inverse ETFs have proven to be relatively tax inefficient vehicles. All right, so you can go on, and I just wanted to, you can read the rest of this, okay? But I just wanted to make this point available to you. And there's all types. There's these similar tax treatments that go on for commodity P's, I guess, exchange traded portfolio here, and they have a similar tax treatment to leverage inverse ETFs. So an ETP, I believe, is an exchange traded portfolio. All right. All right. So anyway, I just wanted to make you aware of this. All right. So you should read up on this and look at all these. Okay. All righty. Everybody, take care.